Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Kamada Ltd, ticker KMDA, a specialty biopharma company that is currently navigating a massive crossroads.
A massive crossroads is putting it lightly. I mean, this story really defines a strategic U-turn. Kamada is executing this really radical value over venture pivot. They're shuttering their high-risk inhaled AAT clinical trial.
AD being alpha-1 antitrypsin.
Exactly. And the ambition here is to immediately transform into, a vertically integrated double-digit growth machine. But the core challenge, the real question, is whether their new three-pillar strategy can actually replace a lost market opportunity that was once valued at over $2 billion.
And that is the ultimate tension we need to analyze today. This entire shift, it really hinges on a single, very abrupt, very high-stakes decision made back on December 8th, 2025. Kamada just announced they were halting their flagship Phase 3 trial, the InnovAATe trial.
And this wasn't their choice, not really. It was based on a futility finding.
So what does that mean in practice?
Well, an independent data safety monitoring board, they looked at the data and just concluded the study was unlikely to meet its primary efficacy endpoint. For AAT deficiency, that endpoint is basically a measure of lung function preservation. They use a metric called FEV1.
And the trial just wasn't getting there?
It was statistically heading nowhere. So management, they made the incredibly difficult call to pull the plug.
I think for listeners who may not be steeped in biopharma, we really need to emphasize the scale of this loss. This inhaled AAT program wasn't just another drug in the pipeline. It was the company's biggest growth driver.
Oh, absolutely. It was targeting the entire AATD market, which, as you said, analysts projected would exceed $2 billion globally by 2028.
We're talking about the difference between a reliable profit engine and a potential home run asset.
And if you look at the bigger picture here, this move is maybe the clearest example you'll find of trading the moonshot for immediate de-risked profitability. They completely abandoned the long-term, high-risk R&D upside that could have delivered, exponential returns in 2030 for something far more stable.
More profitable, more immediate.
Exactly. It's a painful, but I think very disciplined shift in the company's entire risk profile.
Okay, so let's analyze the immediate consequences of this strategic shockwave. Management used an interesting analogy. They said they converted their growth strategy from a four-wheeled growth vehicle into a highly efficient three-engine vessel.
Right, or a high-performance tricycle. The point is that fourth wheel, the inhaled AT, is just gone.
So what's the immediate operational benefit of that subtraction?
Well, the benefit is instant cash flow. It's that simple.
How much are we talking about?
The discontinuation of that trial, it immediately eliminates, get this, between $5 and $6 million in annual R&D cash burn. Yeah, I mean, this is money that was being spent on trial sites, patient recruitment, all the logistics, and that spending just stops. Management expects that entire sum to flow directly to the bottom line.
Which means a direct boost to adjusted EBITDA margins.
A significant boost, starting as soon as 2026.
And this cost saving, it's landing on a financial foundation that was already pretty robust.
Very robust. We have the Q3 2025 financials, and they confirm excellent execution. They reiterated their full year 2025 guidance,
which was revenue between $178 million and $182 million.
And critically, the adjusted EBITDA guidance remains strong, $40 to $44 million. If you do the math on that, it implies a very healthy margin of, approximately 22 to 24%.
That's well above what a lot of specialty pharma companies achieve.
It is. And just to give you a sense of their momentum, their 9-month adjusted EBITDA for 2025 was already $34.2 million. They were printing cash even before they implemented this massive cost-saving measure. They were disciplined even when they were chasing the moonshot.
Okay, so that strong performance allows them to execute this high-performance tricycle strategy. 3 remaining pillars. Let's start with pillar 1, organic commercial growth. This is the stability engine.
Right. And it's built on 6 FDA-approved specialty plasma-derived biopharmaceuticals. These aren't, novel gene therapies. They are essential established drugs.
We're talking about products like Kedrab, Cytogam, Glacia.
Exactly. Kedrab for rabies, Cytogam for CMV, Glacia for ATD, plus Virizig, WinRHO, and Hepagam B. They provide this phenomenal stability because they serve these niche, critical, often sole source markets.
So the strategy here isn't about radical invention, it's classic life cycle management.
That's the perfect way to put it.
So let's use cytogam as an example of that. It's a CMV immune globulin. It's widely used, but they're trying to extend its life and utility.
They are. They're sponsoring the SHIELD study right now, which is a randomized trial. And instead of just using cytogam during the standard window, they're looking at the benefits of administering it at the conclusion of antiviral prophylaxis.
To see if it helps with late-onset CMV.
Precisely. The goal is to get clinical data that shows it reduces the risk of late-onset CMV disease in high-risk kidney transplant patients. It's a really smart, focused way to try and expand the market without massive R&D spending.
Better financial utilization of an existing asset.
An existing high-margin asset, yes.
Okay, but we have to talk about the significant headwind hitting this organic portfolio. I'm talking about the Glassia royalty reduction. This product is licensed to Takeda in the U.S., and that royalty rate just dropped.
It dropped hard, from 12% down to 6%. And that reduction, it lasts all the way through 2040.
That's half the revenue stream gone for a key asset.
It is a massive headwind, and any serious financial analysis has to account for that loss. But what stands out is their strategy to mitigate it. They are just doubling down on direct international sales of Glassia.
So they're increasing penetration in markets outside the U.S.
Exactly. Places like Latin America and the CIS region, that's the Commonwealth of Independent States, countries of the former Soviet Union, they're essentially cutting out the middleman where they can, capturing the full profit margin for themselves to try and offset that Takeda royalty decline.
So it seems like their organic business, Pillar 1, has strong defensive strategies. But if that pillar is stability, we need to look at Pillar 3. This is now the growth accelerator, business development and M&A.
And this is where the pressure is really immense.
Because the internal R&D pipeline is now capped.
Right. They have no home run clinical trial running anymore. So M&A has to take the primary role in generating any future step change growth. They can't just buy a bolt-on product. They need something substantial to replace that $2 billion aspiration.
You do have the resources, though. They have a strong cash position.
They do. Around $72 million as of the third quarter of 2025. That gives them immediate firepower, especially if you leverage that with some debt.
And what's the plan?
They are actively conducting due diligence right now. The stated goal is to find commercial stage assets that are synergistic with what they already do. So we're talking specialty products, likely plasma-derived, that can use their existing manufacturing and distribution channels.
And they're aiming for a deal soon.
They're aiming to secure a significant transaction in the early part of 2026.
What's fascinating here is the pressure inherent in that goal. They have to find an acquisition that not only adds revenue, but has long-term growth potential. I mean, how difficult is it in specialty pharma to find a synergistic asset at a reasonable price, especially when everyone knows you have $72 million in a ticking clock?
It raises a very important question. M&A is notoriously difficult. I mean, biopharma history is just littered with companies that were forced to execute acquisitions under pressure. And what happens? They overpay, they buy assets that don't truly integrate, or they get products facing a patent cliff right around the corner.
So they have to be incredibly selective.
Incredibly. This pillar, Pillar 3, is now the single largest determinant of their valuation 5 years from now.
Okay, let's pivot to Pillar 2. Because this seems to be what provides the structural integrity to support that M&A engine.
Yeah.
This is the company's moat, vertical integration, specifically their Texas infrastructure.
Right. And what's truly unique here is how their investment in plasma collection centers creates this dual financial benefit. They're vertically integrated through 3 centers in Texas: Beaumont, Houston, and San Antonio.
And these centers collect 2 different types of plasma.
Correct. Specialty plasma for their own proprietary drugs, and then normal source plasma, or NSP.
You're talking about a strategy that simultaneously generates new revenue and lowers their own costs. Is that right? How does that work in practice?
It's more sophisticated than just securing their supply chain, although that's part of it. Let's look at the revenue first. The Houston Center is already FDA-approved, and San Antonio is expected to get its FDA approval in early 2026.
And getting a plasma center approved is a huge hurdle.
A massive, costly hurdle. So these are valuable operational assets. Once they reach peak capacity, each of those centers is projected to generate $8 to $10 million in annual revenue.
Just from selling the normal source plasma.
Just from selling the excess material to third parties.
So we're talking about $16 to $20 million in new, predictable, high-margin revenue added to the top line within a couple of years.
That is substantial for a company of this size. Think of it as manufacturing arbitrage. They use the infrastructure to capture the most valuable product for themselves, the specialty plasma for KEDRAB and cytogam, and then they monetize the rest.
And the second benefit is the cost reduction.
Equally important. By internally collecting the specialty plasma they need, they reduce their reliance on expensive external suppliers, and that directly lowers their cost of goods sold, their COGS, which improves gross margins across their entire core portfolio.
So the organic growth pillar becomes even more profitable.
That's it. It's a beautiful structural defense. If the external plasma market ever tightens or prices spike, Kamada has its own low-cost internal source.
Insulating its profit margins.
That insulation is operational leverage defined. It's what gives them so much confidence in those 2026 margin projections, regardless of what's happening in the broader market.
Okay, so we've established a highly profitable, three-pillared structure. It promises strong double-digit growth, improved margins in the near term, and it's bolstered by internal supply security. But we have to address the primary long-term risk.
And this is the critical juncture. The primary risk remains the structural permanent loss of that high upside $2 billion inhaled AAT market. That aspirational blue sky valuation is just gone.
Which means future growth is entirely dependent on that M&A strategy.
Entirely dependent on the successful, timely, and smart execution of Pillar 3. If they fail to acquire an accretive, durable asset, the stock could just trade at a capped valuation no matter how efficient they are.
That is a very valid structural criticism.
Mm.
For the risk-averse investor, though, the company does seem to provide a serious margin of safety.
Mm.
We have to note the contractual stability here.
Absolutely. The floor of this business is high. First, you have a major institutional backer in the FIMI Opportunity Funds. They hold a 38% controlling stake.
Which signals stability.
It signals stability, and it means FIMI has real skin in the game. It aligns long-term goals and reduces the threat of, hostile short-term actions.
And their contractual revenue visibility is excellent.
It is. Their flagship product, KEDRAB, has a supply agreement with Kedrion that extends all the way through 2031. It even has minimum purchase commitments locked in through 2027.
And there's more.
Yes. They also recently secured a multi-year Canadian tender extension for specialty products that runs through 2028. This kind of long-term contract visibility, it provides a powerful safety net against broader economic or market volatility. They know what they're selling for the next few years.
So let's synthesize this entire deep dive. We've seen a radical trade-off. Speculative clinical risk traded for immediate cash flow and better profitability. Is this pivot justified? And, where does it leave the company?
Based purely on the financial and strategic merits, I think, yes, the pivot appears entirely justified. They took a highly uncertain future event, the clinical trial success, and they exchanged it for a guaranteed improvement in the quality of their earnings today.
So eliminating the clinical program risk combined with that operational leverage from Texas, it transforms the business.
It transforms it into a de-risked value play.
And the numbers support that. The company is projecting double-digit revenue and profitability growth in 2026. Driven by real cost savings and core business expansion, not by hope.
Correct. The valuation supports a cash-generating business. It trades at attractive metrics, including a projected 8 to 10% free cash flow yield based on these new figures. The long-term upside cap is real. Losing that potential home run asset hurts. But the immediate profit unlock and the de-risk structure provide a compelling offset, especially for value-focused investors.
So it's a fundamentally safer, more stable company today than it was on December 7th, 2025.
Without a doubt.
It's a compelling
Let's
transition.
hear.
But the story now relies on a major unknown. So here's the final provocative thought for you to consider. Given that Kamada's strategic plan is now fundamentally reliant on M&A, what specific size, or maybe more critically, what type of acquisition leveraging their existing $72 million in cash will be required, and by what timeline, to genuinely replace the lost multi-billion-dollar aspirational value that the inhaled AAT program once held? It's not just about adding $10 million in revenue. It's about generating equivalent future durable growth that can move the needle on a global scale. That M&A decision will be the definitive risk and reward factor for 2026.